Hey, good morning. Hey, I had trouble with my mic. For some reason, I wouldn't recognize it. Now it's there. Can you hear me? Okay, good. Weird. All right. Anyways, hey, good morning. Let me remind you that trading and investing are risky businesses and not appropriate for everyone. Your past performance, good or bad, is not indicative of future results. So please always stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that allows you to trade Forex, energies, metals, indices, and binary options. Very nice. This is a strategy session. It's a couple of hours before the Wall Street Open and approximately London lunch. A great time for us to get together as a team and align our satellites, both technically and fundamentally, of course. And these sessions are hosted every Monday through Thursday at Forex.Today and every Friday at fxstreet.com. Forex trading ideas for today. Boom, boom. Forex.Today. Day. All right, hey, let's do some technical analysis. Typically, on a Monday, we go through the calendar and we go through commitment of trader support and stuff. I just don't feel like it today. I don't know. Maybe I'm cranky or something. I don't know. I just don't feel like it today. So why don't we just do some charts, huh? I don't know. Just cranky. Just so much fundamentals over and over and over again recently. It's just like, really? All right, I think it's over. We're not going to talk about the Fed for a while. Great, let's trade. Trade on, Bubba. Trade on. All kinds of things going on here. Didn't quite hit the target. We were thinking 118-ish. I think it was 118.50. It only went down to 119, so we missed it by about 50 pips. Wah, wah, wah. Cool. This goes back before the big news event. There was two scenarios that we thought would likely happen. One, this mediocre resistance holds and we drop down. I thought there was a pretty good chance that this would go up for a while and then drop, but we just kind of ran out of time, which is fine. And that was if they did raise interest rates, but obviously they didn't. So here we are, and guess what? We're by and large right back to where we were. Right? I wouldn't call it hardcore bullishness in here. Well, let's see, to get there, we had to change directions pretty quickly, right? Drop down to 119, flip and reverse. And here we are, somewhere between 121 where we used to be, 119 where we had visited just recently. We're about a 618 of the rise, aren't we? Because 50% of that would be 120. It's kind of a dangerous place to be. But this could be something good for a while, I'm hoping, where the world is woken up and we know what the Fed's going to do for a while. Right? Because most people don't think they're going to raise in October, just simply because there's no meeting in October, or there's a meeting in October, but no press conference. Yellen did say it was a live conference, but we'll see. And then the big one's December, and she's still talking like it's going to be December. So we got some time to play around with things, right? But also remind yourself that it's the uncertainty that creates the sort of undue volatility and the lack of direction. But she did reaffirm, in my opinion, that she's going to raise in December. So I think we could just play that. My fib indicator. Really? Cool. You know, what I used for, I don't know, the first 9 years of trading was I would just use a Fibonacci study. I mean, you don't need a magic indicator, but if that helps, cool, man. All right. So anyways, here we are, and it's a bit dangerous to start acting now. So you got to make sure you know what you're doing, right? Certainly chasing price is not the right thing. So here we are at a midpoint cycle level, 120.50. Kind of back to where we were. I'd almost call this a reset. And you need to make a decision of what you're doing. Remember, a bull buys low, not high. So buying at 120.50, just by sort of definition, is dumb. And I apologize if I'm offending dumb people. But buying high is just dumb if you're a bull. Right? If you're a bull, you want to buy low. Hang on, I got a text. Hang on. Okay, fine. All right, so that's that thought. So what do you want to do if you're a bull? Another retracement to 120 might be interesting. If you're a bear, how are you going to play this, son? Let's see. As a bear, you would what? Grab here to here. It's almost a 786, so it's not even a good setup if you're a bear, subjectively, right? You would have liked the 618 to be respected down in here. The 618 either of the basically, the last day and a half of trading here, or you would have liked it of the previous range, the way that this is calculated. It's a little off, but that's fine. But you're just not really getting, it's just not amazing. And amazing levels of support and resistance are better, right? So anyways, I think the smart money is going to start playing, I think, what we consider now the inevitable. The question used to be September or December. You understand? September or December. So what's the thought process now? December. Yeah. So maybe just buy some dollars, huh? Now, why did the Fed delay raising interest rates? What did they say? Don't give me your opinion. I don't want your opinion. What did Janet Yellen say was the major reason? Joseph says, so they're front running it. No, Joseph, we're front running it. There is no they. World economic conditions. So what's the wink, wink, nudge, nudge? Who are they talking to? Nah, it's not China. You guys read too many newspapers. It's not China. China is a symptom. EU. No, the Fed doesn't just care about US. No. We work in coordinated fashion. Okay? So yeah, she's talking to Europe, and what is she saying to the ECB? Add to quantitative easing. We're not seeing the results we need, Europe. If Europe pulls its act together, it saves China and Japan. because now their two largest trading partners are online. Boom. Functioning fully with money to spend, disposable income to buy stuff from China and Japan. And then in turn, that increases demand for commodities. Commodity prices stabilize. Commodity currency economies, Canada, New Zealand, Australia, they stabilize. So the key here is Europe. Of course, Europe is slow as molasses on a cold Georgia morning. But, you know, patience, grasshopper, patience. So anyways, yeah, we'd like to see some more QE out of Draghi. So that's the wink, wink, nudge, nudge. I already predicted, what, a month ago, that near the end of October, Japan is going to initiate additional quantitative easing. Ishmael says, today the Federal Reserve is the central bank of the world. Well, today, but since when was that different? When did it start becoming the central bank to the world? How about when Europe leveled itself and sent all their gold to a vault at the bottom of a bank in New York City in exchange for help fighting the Germans? And then the United States nuked twice the Japanese Empire. So, yeah, the central bank here in the United States has been the only central bank for a very long time, not just today. Right? So how do you become a superpower, guys? European banks give you all your gold, all their gold. Yeah. That was the end. That was the end. So anyways, we don't need to go into a history lesson here, but so anyways, support and resistance. All right, here's what I'd like to see. I'd like to see some dumb bears come in and sell it, drive it down to $1.20, and then maybe consider buying her up again. You know, so if I were to, you know, be so bold, you know, this something like this would be nice. You are not alone. Okay. FMI in Spanish, is that right? Yeah. Well, just remember the IMF and the World Bank, they have their own agendas. How about a symmetrical triangle? Well, you can do yours that way. That's fine. All right. All right. So, got to keep an eye on that. Let's do some euro. So, yeah. So, wouldn't it be neat? But between now and the end of the year, we get some more QE. That would be cool, wouldn't it? Now, where did we leave off here? I think it was the 4-hour chart. We see it here on the 1 hour, but on the 4-hour chart recently, okay? Remember we were talking about head and shoulders and stuff. We made the lower low, right? You can see these two red candles are clearly lower than the previous low and broke through this, right? So you hammock that thing. Anyways, it comes back into the 21. 21 acts as a dynamic level of resistance and is now moving down to the next level. If you bought in here and lost money, I'm okay with that. Don't cry about it. Okay, the question is, what do you do if you lost money on this? Do you recognize that there's a lower low? Okay. So that's kind of interesting, isn't it? Now you go to the 1 hour, and it's attractive as well, right? So if you were at FX Street on Friday, one of the things we discussed is how to line up the 5-8 cross with the 2155. So what we had talked about is technically, when you get the 2155 to cross, technically it's a bear. And what you do is you sell the next 5-8 cross down, which is right here. Right? Did anyone attend to that at fxstreet.com? Yeah, Sebastian sold that one today. Congratulations. And Kenny got it? Cool. Well, Wyatt, if you want to front run the 5-8 cross because you believe it's inevitable, like for example, prices up here testing the 21, drop to a 15-minute chart and trade the earlier 5-8 cross. Okay. Which puts you in more like this. See, it's a little earlier. Okay. Warren said, didn't attend on Friday, but I said the same thing in my book. Yeah, well, isn't that the funny thing? 8 years ago, when I wrote that book, I said the same thing. Now, is that encouraging? Like if I was trying to make money off of you, I would package these things up into a new trading strategy, right? I'd say, here's the new trading strategy you have to buy. Why don't you sign up for this training course? And the name, it's got a really funny, catchy name. It's the Zippity Doodah trade. Sign up and send me money, and I'll teach you how to trade the Zippity Doodah. It's the Zippity Doo trade. You just need to know it. It's hot off the press. My new trading strategy. Why would you want a new trading strategy? What you want is the old trading strategy. Am I right? Yeah. Wow, my coffee's like frozen cold, man. Whew. I guess that's pretty funny, Wyatt. So, anyways, you're lucky that we're a team. I consider you a team member, not a BMW payment. So, anyways, we're testing some key levels here, and we're breaking some key levels, and I think it's pretty exciting because we've been in a range for a while, waiting for the Fed. And I'm hoping the market is just cool with it, and they're just thinking December. But at the end of the day, we have to read into this. We don't know for a fact what the market's thinking because the market is made up of very diverse market participants. Okay. So do you see this pattern over here that we talked about last week? I think it was maybe a week before. Well, what if we did something like this? Okay, came down to here, then we hesitated and we say, wait, the Fed's not going to raise yet, the Fed's not going to raise yet. And it comes back up here, right? And then what? You see this part? This would be the right shoulder. So what you would do is you'd measure this distance here. and you'd move it, okay, and that would be the new target. Some people will do it this way as well. You take that distance and you'll plot it for the neckline. You could do it that way as too, depending if you're aggressive or conservative. And so what that's saying is, you know, down to 12, up to 14, down to 10. Does that sound pretty reasonable? That would be the aggressive move. Cool. So Sam says, well, 2155 is still going up on the high time frames, but we're looking at this low time frame. So Sam, this is why this type of pattern occurs. It drops like a ton of bricks, hits support on the daily, but the support's going to break at some time, is the thought pattern, okay, Sam? So a bear comes in, says, oh, I see the daily support. Oh, I see the daily support, but we're going to break it. There's just more bears than bulls, or the bulls take profit and become bears by simply offsetting their longs, which is kind of the same thing but different. Either way, we get a little short-term bounce, let's say up for a day, and then those bears that originally took profit at obvious daily support will short again, but this time there's no orders down here by the bulls. The bulls just say, forget it, it's over, I ain't going to do it. And we just cut through that like butter with a hot knife. Sam, what? What do you mean? You said 2155 on daily. You're so funny. Oh, I didn't mean that. I mean 5.8 on the hour. Sammy, Sambo, Samarama. Well, forget it. You made a really good point by mistake. Hey, man. Don't blame yourself, blame your mom. All right. So, yeah, let's just see where this goes, huh? Some down. It could be a big one. And notice that in this example to the left, I have it as a crown. And the difference between a head and shoulders and a crown is that this right dip is bigger than the previous dip. And all that would do is give you a longer extension. Okay. And probably less of a retracement. So probably more like that, if you want to do it like a crown. Okay. But remember, I laugh at all these things because there's so many complicated patterns that, you know, authors of books and various strategies and educational courses are trying to sell you. They're trying to tell you it's complicated. Remember, trading is not complicated. Only that people that don't know how to trade make it complicated. So what you should be doing if you're a genius is making it simple. So the key is everything on the right. The key is the lower low. You can't have this crown pattern or a head and shoulders pattern without a very, very, very significant significant pullback or reversal in the existing trend. All that matters is the right side of the pattern. I don't care about the left. So to me, there's really no difference whether it's a head and shoulders or a crown. You don't need to learn both. There's only one. You see what I mean? So like, look at this pattern here that I gave an example a week ago. The left side is still bullish. It's not a reversal pattern. There's nothing reversible about it yet. What's the reversal part? This part. That's not going to let me do it, right? The only thing that means reversal is this part right here. because it made a lower low. Well, how could you have a lower low in an uptrend? You can't. So that's it. The whole reversal pattern is this. That's it. That's the reversal pattern. So why do I have to have, 3 or 4 or 5 different versions of the same thing, have different names for them, have different rules and all this kind of stuff? Well, because I'm trying to sell you something. What you need is the lower low doesn't belong in an uptrend. Things could be changing. Okay? That's all. So I think this is going to be very interesting. I hope these are the beginnings of the trends that we're looking for, right? We got the Fed stuff out of the way, guys. What if, and let me just see how this feels with you. What if you made a trade in the next 54 hours and you held the trade until December 31st? Would you like to give that a try? Just for fun. Just say, you know what? Wayne never asks me to do these things. I'll do it. I'll see what it's like, just for fun. Yeah, Kenny's like 4 or 5 is max ever. Okay, so here's what you do. You make a trade as you normally would. You don't get sloppy. You don't get stupid. You sell at resistance. You buy at support in the direction of your longer-term charts or your fundamental bias, whatever you want, but make it smart. Okay? A good, solid trade. And then you manage it as you probably normally would, but so let's say, what do you risk, 50 pips? Don't move your stop within the first day. If you don't feel comfortable losing the 50 pips, adjust your lot size. I mean, make it a micro lot if you have to, but just do it. But make sure you feel comfortable with it, that you can afford it, that this is a strategy that you want to practice so that the reward here isn't filthy, stinking rich. The reward is experience and possibly confidence. Okay? Are you with me on all this? And if that still is too expensive, use a demo account. Okay? Well, Igor says enter on a 15-minute chart, but hold it for weeks. Well, like I said, you need to be smart about it, Igor, right? So the answer, of course, is maybe. What do I mean by maybe? Well, yes, I probably would pull the trigger on the 15-minute chart, but I'm going to look at the hourly, the 4-hour, and hour as well. And when they're congruent, yeah, I probably would pull the trigger on a 5A cross on a 15-minute chart. But I wouldn't do it with only the 15-minute chart. But if it's kicking off of a 4-hour 21, well, yeah. But I'm not trading the 15-minute chart. I'm trading the 4-hour 21. But I'm pulling the trigger on the 15. Okay, that's called fractal geometry. But either way, it's a smart trade. Make the trade you can. Okay? And then, let's say 24 hours later, or at least the next day, you can consider moving your stop to break even. Okay? And then, just for fun, just for kicks and giggles, you stay in that trade till the end of the year. And if you get knocked out, what's the big deal? But I want you to develop discipline. Sometimes discipline is staying out of a trade. Sometimes discipline is not chasing a trade. Sometimes discipline is waiting for the proper entry. And all these things are frustrating. But when you're a professional, you're not afraid of all those things anymore because you're good. I mean, you got the skills, you've developed patience and discipline on that end of the trade. That's not the problem. So in my book, one of the things we do talk about, which I doubt you get anywhere else, but of course I haven't read anyone else's book, so I don't really know. But I talk about amateurs fear loss, but the big fear that professionals have is profit. And think about this. You're up 150 pips, and every bone in your body says, get out of the trade, doesn't it? Take your profit, 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 take your profit. You can't sleep at night, especially if you got 20 trades open with an average of 150 pips. What is your body? What do you think about all night? You're tossing and turning and rolling around in your bed. Yeah, because you're making money, right? This is the problem, especially when you have carry trades and you're up a bajillion. You just can't sleep at night because of all the profit, but you planned on being in the trade for weeks and months. And maybe in the first 2 weeks, you're up a huge amount of pips and you just can't sleep. Yeah, I mean, you get to the point where you feel like you're suffocating. I'm not joking. You're suffocating. It dominates your mind, but your body physically. Like it's kind of thing like you're outside throwing the frisbee with your kid and you get hit in the face with the frisbee because you just, in the process of throwing the frisbee, you lost your mind. You're just like, oh, sorry, I forgot we were playing frisbee, right? Knock your front teeth out. But it just consumes and dominates everything. So part of the practice here is I want to prepare you for success, and I mean ultimate success. And so it will be good for you to have a trade on and you're up 300 or 400 pips and you're like, this is the biggest trade I've ever had in my entire life. Yeah? So, do you think the rest of the world cares? It's only important to you. Could be worth 1,000 pips. Okay? So part of the discipline is let it work itself out. Okay? And so I want you to practice your inevitable success because of all the hard work you're putting into your trading. And so let's throw that in there instead of working on the same old things. And let's just see what happens. Okay? And maybe by the end of the year, at Christmas time, you'll send me some fabulous wine and some Cuban cigars, and you'll say, thank you, Wayne. That was my first 1,000 pip trade I've ever made. And I'll say, thank you for the cigars and the wine. I really appreciate that. And yeah, and everyone will be happy. Especially me. Can you imagine 100 bottles of port wine or whiskey show up and I have over 2,000 Cuban cigars to smoke because of all you guys and your success? Whew. Well, at least my friends will be happy. Oh, I'm a Rhone Red guy. Yeah. Chateauneuf de Pape. It's my thing. Anyways. Right on. Yeah, anything with a Grenache. Chilean Carmenere is quite nice too. Anyways. Yeah, so let's go to the piggy. Piggy, 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 can't you see? So a lot of money. Thank you, Charles. Yeah, Charles, as a hobby, I actually started a tea company very briefly, but then we got hit by the 2008 crash. I'm like, all right, turn that hobby off. So yeah, I used to have tons of tea. Yeah, so here we are. Kind of looks like we just drew this now, doesn't it? Except we drew this in May. Isn't that funny? So here we are in almost October. And we have the higher high, significant pullback. right? Higher high, but not much of a higher high. Significant pullback. Consolidation, lower high, loser, right? Lower low, shields up, red alert. Kind of feels like a 1, 2, 3, doesn't it? And that would make my analysis for May correct. Because we did hit the 50, then we have consolidated, then we dropped, and then perhaps if this is a lower high and it kind of Stokes is kind of looking like it wants to, then this will make the low, which would confirm this high, which we made back here in middle of June. Huh. Actually, it might have been the beginning of June. How cool is that? That would be the complete rollover and collapse of the British pound. Months and months and months and months and months and months. And all this is the low for March. So what you do is you measure the high to the low, come up to the fib, how far is it going to retrace, and you take some of these levels and you can see like where price is now. Kind of looks like that could be a resistance area, right? Isn't that neat? But we've already done all this, but it's nice to revisit. Follow the price. This kind of looks like a resistance area, and this, 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 and this. Okay? So how cool is that? Now, the thing is, I don't believe that this is going to drop where Fibonacci is predicting. Because remember, it's just technical analysis. It's just measuring what you want it to measure. It'll tell you whatever you want it to tell you. But it's not telling you what the Bank of England's going to do in February, is it? So one of the things that I've been paying attention to, and I'm guessing at this point, but I have some good reasons why the guess is logical, let's say. I'm guessing that the Bank of England is going to shock the world and start raising interest rates in January, February, or at least tell the world that they're seriously considering it, which is the same thing. It's called jawboning. Okay. So this could be interesting for now, at least, right? And we're in this big question mark area. It's a big question mark. So you could line it up. So what happened 1, 2, 3, 4, 5, 6, 5 or 6 hours ago? Was that the London Open? And was that the London Open after a lower low in an uptrend? And was that a 3A2 Fibonacci retracement? In a retracement of its own? This is why I like trading, man. This is fun. I'm reading Jim Rogers' new book, and he's funny because he was just saying how when he got onto Wall Street and started trading, he's like, I just loved it. He said I consumed it, everything there was. And I know that feeling. All right, so yeah, let's just leave that. You need to, and I think it's tricky because there's a lot of money coming out of Europe going into the banks in, in London. So it's a little bit tricky. You got to be a little bit careful. I don't think it's always going to be so simple. And I think once you drop it, if you look at your daily chart, you can see it'll drop a couple hundred pips, but then you're going to slam into old support. So I don't think it's going to be an easy trade. So there's the caveat for that. And just think about it. Like, if the money is coming out of Europe, where are they putting it? If you were a billionaire in Greece, where do you put your money? London. Close to home. Okay, let's do around the world. Around the world. Around the world. Well, Alexander, why not Switzerland? Tico, why not Switzerland? Do a comparative analysis of putting your money in a Swiss bank versus a British bank. One, the bank in London will pay you interest. The bank in Switzerland will charge you interest. Which one do you want to be guaranteed? To make some money or to lose some money? There, you just answered. That's why. Cool. Oil. Cool, we're still in my range. Not heading down is bullish to me. There we are. We're just sitting there and everything's comfortable at this rate. Remember, there's no reason for this to go down and there's no reason for this to go up. Now, the only person saying that this is going to fall all the way to $20 a barrel is Goldman Sachs, but most likely they're calling all their clients and they're going on TV and they're writing analysis reports saying that so that you'll place a trade. Right? Oh my gosh, oil's going to go down to 20. You better get in all that, son. But yeah, they're talking the book. They want you to trade. How do they make money? They're giant brokers is what they are. Hey, you need to get in on this. It's a gravy train. You need to short some oil futures. It's going to go down to zero. Really? All right. Well, if that's what you think. So here's what I suggest, and this is my advice to you for forever since I've been speaking publicly, which is over 10 years as far as trading, that nobody cares about you except your mother. Your mom loves you, but nobody else cares. Nobody. And if they're telling you what to do, it's not in your best interest. It's in their best interest. So you need to listen to nobody. And that's people calling you up, giving you trading ideas. That's people sending you alerts. Let's say you sign up and pay money for something. They're not looking out for their best interest. They're just throwing down a trade, whatever that means. Right? What you need to do is to be able, and to carry this further, newspapers, television shows, all that kind of stuff. I mean, look, you're the only one that can take care of yourself. You have your best interest at heart. You may not do what's in your best interest, which is behavioral finance, but at least you have it at heart. And you have the capability of making your own decisions. You have the capability of doing your own research. And you need to be the one that pulls the trigger and manages the risk. Okay? And I need you to learn how to take care of yourself, because at the end of the day, it's you It's your family, it's your loved ones, it's your mortgage, it's your car payment, it's money tucked aside for when you're sick. Nobody else cares. So you got to take care of yourself, and that's what I want you to learn how to do. So I'm looking at oil here, and it just looks like the trend is down, and we're not falling any further. And it seems to me the market's at harmony. Supply can go up, but there's no incentive. See, like, why would oil go down to 20? There's no incentive for those that are in the oil business to do that. So the one thing that the oil guys can't control is the dollar. And the dollar will likely go up over the next few years. And that could negatively impact oil prices, because if $1 can buy a little more oil, it's the same as the price of oil going down. But I don't think it's going to be huge. Like, it's not going to be 10 or 20% dollar appreciation. You know, that's ginormous, but maybe it will be. But even then, what's 20%? $8, right? So, you know, I don't know. Is it going to go to 20 because of the US dollar? No. I think it would be ridiculous to think about $8 or $9 difference simply because of the price of oil. But even then, that doesn't even get us down to a lower low. You know what I mean? So 40 to 60 bucks is probably oil for the next 5, 6, 7, 8 years. What's going to change oil prices? Europe. Where everyone's sitting around waiting for the ECB. When we know you need to be very patient. Right? Because they, you know, we know Europeans, right? Like to work 3 hours and then go outside for a smoke and a glass of wine, and then go on vacation, and then come back and strike. And then after the strike, after the vacation, they get back together and talk for 3 hours, and then more cigarettes, more wine, more vacation, more strikes. So it takes a while, but it's just a cultural thing. That's all. I'm sorry if you're European, or if you knew a European, or your mom was, or your grandma was born in Europe. I don't mean to offend anybody, but I do exaggerate for effect. And the ECB has always been dramatically slow. Okay? Seriously. Always. As long as, if we were talking about Trichet, it would be the same thing, where the Europeans, you know, their feet would be on fire, and it would take a week and a half for them to acknowledge their feet are on fire, another 3 months to discuss what they might do about their feet being on fire, and then they would make an announcement. Our feet are on fire, and we're going to throw water on our feet in 3 months. We're not going to do it now. We're going to do it in 3 months. And then another 3 months goes by. You're like, wow, that is amazingly slow. But I've learned that over many, many, many years of being a currency trader. So I do exaggerate for effect, but it is a fact. And I'm trying to prepare you to be as patient as possible, but the whole world is waiting. Oil, put it this way. There are two things going on with oil. Too much supply and not enough demand. The supply issue ain't going away, baby. So the only thing we could fix now, right? The only thing you could possibly do here is increase demand. But there's more oil than we could possibly use in 100 years. And I know just a while ago there were people talking about peak oil and it was the end of the world as we know it. But like humanity always seems to do, or does, is it focuses its mind on, as a global brain, let's say, humanity focused on the problem, came up with a solution. So now, suddenly, we got way more oil than we could possibly use for a very, very long time. That ain't going away. Okay? So what we could do is increase demand. Well, demand out of the United States is all right. Okay, it's all right. Demand, I mean, we're moving along. Everything's fine. But demand in places like Europe, which traditionally would have used a lot of energy, is just low because their economy is flat at best. So if Europe could get its act together and start up their factories and start up their get people employed and get people confident and give wages in their hands so that they have disposable income, and all of a sudden that economy would add to the global demand side of the supply demand equation curve, right? So Europe would help with the demand. And then, of course, Europe then helps China, and then China helps Australia, Canada, New Zealand, and Brazil, and all of a sudden those come online, and now we have global demand again. So quite literally, we're all sitting around waiting for the Europeans again. And if you think I exaggerate a little bit on that last analogy, go look at how long it took the ECB to do quantitative easing. Well over a year. Now, there were some structural reasons for that. They didn't have the legal authority. But even then, it took them an unbelievable amount of time to get to the point where they wanted to even ask for the legal authority. And the Germans actually gave it to them pretty easily, in my thought. So anyways, it's going to be a while. That's all. Yeah, Kenny says Japan's going to benefit from low oil prices. Yeah, the only thing is nothing's happening in Japan, so it'll be cheap, but no one's using it. So anyways, that's oil. It's going to be a big nothing for a while. And then going to gold, gold is also a big nothing. It's a non-important investment. Okay. But we need to pay attention that there is something different going on. I'm trying to grab this. Okay. And technically, that's important, isn't it? Okay. Now, I've drawn this red zone. Oh, very, very long time ago. There we are. So it kind of feels like we're topish here. And no real reason for it to go up, no real reason for it to go down. And what we were saying, even when it's collapsing fast, I was telling you, don't worry about it. People are going to buy it just below 1100 because what they're trying to do is support 1,000. Those that are own physical gold are going to try to support the 1,000 floor, but they're not really buying it. They're just defending a psychological price. And then there's no reason to own it relative to other investments unless you think it's the end of the world as we know it, but of course it's not. So this is just people panicking. And then like oil, I think this probably just moves sideways for, I don't know, forever until something changes. So I wouldn't get too eager, but we'll see. That's all. Don't worry about it. Oh yeah, let's move over and do CAD. Well, yeah, let's do CAD. I'm gonna do it over here. It's the end of the CAD as you know it. All right. All right. So Horace, are you still using? Are you still hedging CAD? Where's my buddy Horace? Yeah. Are you hedging CAD? No, supposed to be. So look what happened. Look what happened, guys. CAD fell all the way down to support. It's not even key support, just moderate support based on this area in here. Fell all the way to support and then bounced. Now, the velocity of that is interesting, but amazing, huh? Just moderate, mediocre, boring support. But 130 seems to be the psychological level, huh? So that was Friday's close, and we're up 200 pips now. John, I do not expect a dramatic drop in the S&P 500. Okay? I don't. Why would I? Give me one reason why fund managers and mutual fund managers and wealth managers all would like to dump their portfolios they've spent the last 6 years building. Give me one reason. No. There's no panic selling. I just told you. Fund managers, let's say like an institutional investor investing money for like a teacher's retirement fund, okay? Wealth manager that manages money for a millionaire, right? That kind of thing, so on and so forth. A mutual fund manager that's long-term long only, and they have billions of dollars under management, and if they go to cash, that their clients just simply revoke the money. There's just absolutely no reason any of these people are going to get out of their positions. It would be like saying, you know, you want to wake up and cut one of your fingers off. Typically doesn't happen. Even on a bad day, that would be very unusual. So it's their job, John, and this is the vast majority of the market. Their job is to buy a stock and hold it for a long, long time. And as long as they report that the stock market went up, their annual report will show a profit. And the money keeps pouring in. That's all that matters, is that big, giant money machine is stable. And all they really need to do right now is beat inflation, which is zero. So as long as the stock market's going up 1% here and up 1% there, the money machine's going to keep working. The $75 a week that comes out of your paycheck and into your retirement account is going to keep doing that week after week after week after week after week after week after week. So dumping these positions and liquidating your portfolio is, you know, financially suicidal to a fund manager. It's just not going to happen. Okay. Most market participants are investors and hedgers. Okay. Well, and Michael says all they have to do is beat the average, but even then they don't generally beat the average. Well, okay, John, I would imagine you would have a slightly different view, but we're talking about the market now, and we're talking about the functionality of the S&P 500. It's just, I don't think it's going to work that way. Okay, the vast majority of the market participants make money on the way up, not down. Okay, and they make money by charging, you know, essentially management fees. So they're going to buy low, and then they're going to buy lower. Okay. And then I think if you're going to be like a short seller or something, I'm not a professional short seller, so I don't know if I don't think you would short an S&P 500 stock that will just simply be gobbled up by mutual funds. If I just got to think that there's an algorithm somewhere that says, if company A drops by 7%, buy it. And your short selling just gets squeezed, like boom. Because think of it this way, and again, I might be wrong. I'm drifting a little bit into stuff that's not necessarily my expertise. But if you're a mutual fund manager, and I think there's only 70,000 mutual funds, is that right? Is it 70 or 7? 7 sounds like a lot, but it might be way more than that. Does anybody know? But, okay, let's say there's 7, but I think there's more. Let's say there's 7,000 mutual funds that generally have to follow the same rules. 1, no leverage. 2, no hedging, which means no short selling. 3, you can only buy S&P 500 stocks. Now, obviously, with 7,000 different mutual funds, the structure of each is going to be slightly different, and they'll have slightly different rules. But by and large, these are widely accepted assumptions. Okay, so they only can buy, and they can only buy S&P 500. Okay, so it says to me, if I'm going to short sell, I'm going to short sell something that's not on the S&P 500. Or if I'm going to short sell, I'm going to short sell it for an hour or less than a day. You know what I mean? 7,238. Thank you, Anthony. So yeah, my first guess was right. Not bad for an old man, huh? So, considering the rules of the game, like how much money is in the 7,000 mutual funds, Anthony? Can you ask Google for that? It's a lot of money, yo, as they say on the block. Right? $1 trillion here, $1 trillion there. Pretty soon it adds up to real money. So I wouldn't want to fight that kind of wave. I think you would want, something else. But even then you could. But you would be a hedge fund manager at that point fighting against mutual funds. And sure, they're slow and stupid and all that kind of stuff. So, but that's a whole different war. The vast, 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 vast majority, 65% of Americans are in the stock market through their retirement accounts. Those retirement accounts invest in your mutual funds. Mutual funds can only buy S&P 500 stocks, and they can only be long. So you're actually fighting 65% of Americans. And the other, what is it, 35%? They're just not in the market at all. So you're fighting everybody now, honestly, right? So on the long run, I'd rather be with that money. So when I look at the S&P 500, everybody makes money on the way up. Do you understand that? Everybody makes money on the way up. And that the farther it falls, the more likely someone's going to buy it. And as soon as somebody buys it, everybody else is going to buy it. Given that view, yes, the market can only go up unless people get out of the market. So I'm going to go all the way back to my first question, John. Why would they get out of the market? It's like quitting. Hi, my name is Wayne McDonell. I've been your mutual fund manager for the last 7 years. But I quit. Here's your cash back. I'm out. Okay? Yeah, but John's saying, well, you get out because of the loss of confidence in the U.S. economy. But now you're talking, radicalism. And now if you're going to go that angle, I'm going to put you way out on the fringe. Just you're way out there. Like the guys that were talking about peak oil. It's the end of the world because we're all going to run out of oil and we're going to end up in global war because there will be no energy. Now we have so much energy we don't know what to do with it. So just whoa, 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 whoa. Way over there, dude. Or you join the rest of the world and the economy is fine. It's not great, it's fine. The institutions are working. The $75 a week coming from people's paychecks going into the retirement accounts, they're still showing up week after week. People are buying houses. People are spending money on their credit cards. People are going to work and driving and buying cars and paying for insurance and putting gas in the tank, and the prices are reasonable. Everything's moving along. The next step now is for Europe to get its act together. And then it's going to be China and Japan and other exporting nations, and those factories will start coming online. It'll be their turn to improve. And then once that happens, demand for commodities will pick up. And then you have Australia and Canada and New Zealand and Brazil. You know, where's the copper going to come from? Chile, right? And all of a sudden these countries start doing well, and then those countries do well, and then they start spending their money, and globally everything will just be fine. Everything is just wonderful. There's nothing that says craziness. Okay? Technically, we've had a dramatic pullback. Now, just remember, there's a lot of people, making decisions, sometimes rash, but not necessarily, on current events like whether the Fed's going to raise interest rates in September or December. Okay? Is that even really an issue? Yes, I'm sorry, Wyatt. Well, you guys are you're the boss. I'm just a humble currency trader. So you took me to the fundamentals. All right. So is it a serious issue, honestly, whether the Fed raises in September or December? I mean, who cares? So who did care? The idiots that bought this trend at the top. Oh, there's always idiots. Don't worry about that. Okay. So, so Igor says that, is a double bottom. Is this a double bottom? You could call it whatever you want, but I think all it is it's volatility where there were some idiots up there that threw in some dumb money on some dumb ideas, and of course they get whacked out, right? Stops are hit and panic buttons are, hit and whatever, and it drops. What did the smart money do? What did the smart fund managers and mutual fund managers and all these other guys that actually are doing their jobs and they're staying calm and they're looking at the facts and they're like, dude, if you want to drop the S&P 500 5% in a day, I'm cool with that. I'm going to buy some stock. Because in 2 years and 4 years and in 8 years, it won't mean a dang thing. So Igor says it's going to drop again. All right, well, then you better sell. Then that's not a double bottom. That would be a retracement. And I think that would be fine too. I think if it fell, I don't think it can't fall down in here. So, if it's going to fall, I think there's enough cash in the economy that people are going to buy it on the way down. Yeah, okay, back to so is that what you're talking about? That's the crash from here to here? See, that's nothing. That's just nothing. Yeah, buy it. Oh, you didn't say crash, but drop or okay. Well, fine. Yeah, all right, sure. Drop it down here, and then it'll go back up. That's fine. Yeah, sure. Easy. It's just noise. Sure, sell it, buy it back. Right? Sure. Just to that area, fine. Easy peasy. But what's most important is you don't spend a career shorting the S&P 500. You have to be, especially when you're shorting individual stocks, you really need to be well informed. You need to really be smart. I think you could be a dummy and make money in the stock market, and trust me, it's been proven to me many times. You could be a dummy and make money in the stock market, but you have to be pretty smart to short sell because you need to know that everybody else is wrong. And here's the more important thing. You need to know that everybody else is wrong and they're going to find out that they're wrong and react. That's a lot of ifs. And if you're a dummy, it takes you a very long time to realize you're wrong. So, what did Keynes say? The market can stay irrational longer than you can stay solvent. So no matter how right you are, it doesn't matter. You're still going to lose your shirt not most of the time, but you certainly are setting yourself up. Another way of looking at it is a short seller has limited downside and limited upside, but unlimited downside. So just structurally, it sounds ridiculous. Now, I love shorting like futures contracts and stuff like that, so don't get me wrong, but individual stocks, and especially if you're looking at big money and you're going to be like a hedge fund manager doing this, you really need to be by far the smartest guy on the street and extremely patient. Okay. So backing out here, this is the European stock market. Okay. We talked about your opportunity to buy it at 50% off. That's long gone. So here we are. We've made basically a 3A2 Fibonacci retracement. So let's just play a game here. Let's say the DAX keeps falling until what? What clue did I give you today that would predict that the DAX is going to skyrocket? Okay. When will the ECB, and I'll add insult to injury, when will Draghi take his orders from Janet Yellen? Ooh. Drama. When will he increase quantitative easing? Give me a date. October what? There's no around, Anthony. Give me a date. No. Why would you wait after the Fed? October 17th. Is that the ECB meeting? Right? When's the ECB press conference? No. When is the next ECB press conference? Someone needs to confirm that it's October 17th. I thought it was a little bit later than that. Or even earlier. I thought it was right before NFP. Is it later, this 22nd now? I need someone to confirm. Okay, so that doesn't seem right, does it, Timmy? But you see where I'm going? I still would appreciate if we can get 3 people to confirm when the next ECB meeting is that has a press conference. Okay, thank you guys. So the community says October 22nd. Do you understand what just happened? The euro's going to crash and the DAX is going to skyrocket. And you're going to be on the trade. And what is the focal point of this particular strategy? The Janet Yellen says she can't raise interest rates even though most market participants wanted her to. Whether that's right or wrong doesn't matter. She was under a huge amount of pressure to raise interest rates, and she couldn't because Europe is dragging their feet. Wink, wink, nudge, nudge. You know what I mean? A little more QE. Wink, wink, nudge, nudge. So now all you have to do is know, well, when would they increase interest rates? Or sorry, when would they increase QE? Well, when's the next opportunity? Now you can start slowly front running that. Yeah, I thought it was somewhere between right before NFP, but just keep an eye on it, right? Well, John, again, that's your alpha. The way, so you got a strategy, and then you have your tactics. So whatever, it's whatever you decide. That's your ability to outsmart the market, even though the market has the same information as you. But has Bloomberg or Wall Street Journal or Investor Business Daily or Financial Times, has CNBC outlined the facts that clearly for you? I don't know. I don't read any of those things. But I doubt it. So, all right, guys. It's been real. I'll see you tomorrow, same time, same place. My name is Wayne McDonell, and this was your daily Forex trading strategy session. Thanks to Forex.Today. See you tomorrow. Thanks for being on my team.